Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines at this hour. President Ramnath Kovind will swear in his cabinet, including Prime Minister Modi, on May 30th at 7 p.m. The Reserve Bank of India proposes to strengthen the liquidity framework for NBFCs, including introducing a liquidity coverage ratio. Jet Airways founder Naresh Goyal and his wife are detained from leaving the country by immigration officials. And 1% Beverages managing director and CFO were arrested for trying to evade GST worth 40 crore rupees. Well, let's take a look at the trade setup for the day. Remember, the US markets ended the week, which is Friday's session, relatively okay, about 1/3% or thereabouts for the Dow S&P. So it was not a bad close for the US markets. Dow about 95 odd points in the green. The setup in the rest of the Asian pack is mixed, not too buoyant, not too pessimistic. It's a flattish kind of a start, and that's what the SGX Nifty indicates as well. After a rollicking week that we've had, the last one, we probably have on hand a start which is mildly sedate in trade. I think the question marks over whether or not the valuations are steep or expensive is anybody's guess. Frankly, when money starts coming in, even expensive valuations don't matter. So I think it's a futile argument to try and predict what the Nifty will do in the near term. Best left to technical experts. What we can try and do is look at what the Nifty has done vis-a-vis what the broader markets have done, and try and figure out if indeed the broader markets would now start plowing back. Now, look at this. From the lows of Jan 2018, the Nifty is up 17%. Mid caps and small caps are not up as much. So on a relative basis, it's a 25% and 33% underperformance that the mid caps and the small caps have vis-a-vis the Nifty. And therefore, the question to ask is, will individual portfolios with betting on mid caps with strong fundamentals and cheap valuations now give rewards? Because the market will not be as circumspect about the run-up in the mid caps and the small caps as it probably was a few months back. And if indeed the flows to the mutual funds and the equity flows to the mutual funds kickstart again, then that money will find its way into the well-valued mid caps and the small caps. So I think that's the question that you got to ask. Speaking of flows, for now the money is coming in from the FI side. So DIs may be absent, but FIs continue to pump in money. Last week has been quite spectacular. Friday, the maximum number that I've seen last week, which is of 2,000 crores coming in on Friday. So good day, good flows. Let's wait and watch whether that continues or no. It'll be an important day of earnings as well today, aside of the reactions which I'll talk about, but a clutch of very important results coming out today. So Adani Ports has been on a roll the last few days, and it'll be important to see if the numbers meet the kind of uptick that we've seen in the stock. Zee Entertainment, because of all that's happened in the recent past, naturally becomes a very, very important number to monitor. As also GAIL, by virtue of it being a larger name. And then, of course, the non-Nifty larger names, the likes of Motherson Sumi, Interglobe Aviation and Colgate-Palmolive will all be very important. You're looking at Motherson Sumi to see if their commentary or their numbers show any kind of stress on the global trade front in their books. Interglobe Aviation, of course, becomes an important number because of what's happened to Jet and because of the possible difference of opinion between the two promoters and whether or not any kind of commentary comes in around that. And Colgate-Palmolive, people will be watching out for whether or not the volume growth numbers are disappointing or are they're pretty decent. And amongst other things, something that we'll watch out for today will be what happens as a result of RBI's proposed NBFC norms. I won't dwell too much on them right now. We'll be talking about them in just moments from now. But keep in mind, this is what CLSA is saying, that the tighter liquidity norms will hit margins and it'll be worse for NBFCs with an ALM gap and low ratings. The negative spread on GSECs can be in the 200 to 400 point range, but they maintain that their top idea in the NBFC space is HDFC. Essentially, well-run NBFCs might be better off. This interesting times for NBFCs, and therefore people might want to stick with the stable. However, in terms of stocks to monitor today, stocks that will come out with numbers, there are 2 or 3 key names. One of them is NTPC. The numbers were below estimates. Revenue about 8% lower, EBITDA about 21% lower, other income up about 2.6 times. So miss, but NTPC is usually a very stable stock. Let's wait and watch if it reacts today. A very strong quarter for companies like Nagarjuna Construction, Balrampur Chini, Narayan Hrudayalaya, even India Cements, all of them went up because the market as a whole went up on Friday's session, but extremely strong numbers, particularly for Nagarjuna Construction. Watching out for this stock very closely in the session today, as also, by the way, India Cements, which came out with a very good set of numbers. 1% beverages will face the rough end of the stick. The press release from the GST department suggests that managing director and the CFO have been arrested in GST evasion case. I have no doubts that the stock will start off lower. Locked on a circuit. So let's wait and watch what happens post that. And from amongst companies that came out with weaker numbers, Page Industries, the margin miss will be something that might hurt, though the management has guided to a reasonably optimistic FY20. Let's wait and watch if that brings about any kind of positive reactions, but the numbers were very weak, should react. And weak numbers from some mid caps and small caps, including the likes of Coffee Day, Butterfly Gandhimathi and Excel Industries. So let's see what happens to those stocks in the session today. Margin miss seen across all of these companies. However, let's tell you what's lined up on First Word today. As I say, it's the collection of the top editorial stories. We take you through the fine print of RBI's draft rules for NBFCs, and we speak to Repco Home Finance about them. The auto sales slowdown has taken a toll on the ancillaries. Yatin Johnson to tell us just how much. And then with Indigo coming out with numbers today, Somit takes us to the expectations from the two listed operating airlines in the country. Well, the Reserve Bank of India is taking action to avoid another crisis like that was triggered by IL&FS. The regulator has proposed rules to tighten the liquidity framework for non-banking financial companies. Now, will this be positive? Will this be negative? Will this be neutral? You would argue that for the non-well-run NBFCs, it will be negative. So let's take you what the proposal is. They're going to introduce liquidity coverage ratio, or LCR, in phases from April 20 to April 24. LCR keeps on moving up as we reach the 2024 year. They are going to limit the negative asset liability mismatch for maturity up to 30 days. Implement liquidity risk monitoring tools. By the way, all of these are proposals. The RBI has asked for feedback as well, so keep that at the back of your mind. They're saying that they want to adopt a stock approach to liquidity and extend the liquidity risk management principles to other liabilities as well. Now, the proposal also, when it speaks about extending the liquidity risk management principles, it speaks about off-balance sheet exposures, contingent liabilities, stress testing, and intra-group transfers, as well as diversification of funding, so collateral position management and contingency funding plan. Essentially, on all of these norms, the RBI is seeking feedback from participants by June 14th of the current year. Now, who the rules apply to for now? The RBI's rules apply to all deposit-taking NBFCs, non-deposit-taking NBFCs with 100 crores of assets, and core investment companies. Eventually, they'll be extended to all forms, but for now, the proposals include all deposit-taking NBFCs and the non-deposit-taking NBFCs. Most people believe that this will help NBFCs in the long run, but the near-term companies with ALM mismatch will be hurt. Let's try and talk more about this and make better sense of this. Joining us on the show now is Mr. Yashpal Gupta, Managing Director and CEO at Repco Home Finance, and from the analyst community, Siddharth Purohit, analyst at SMC Institutional Equities. Gentlemen, both of you, good morning. Thanks for joining in. Mr. Gupta, to you first. Where the industry had first, we'll come to Repco Home in a bit. Well, where the industry had first, and tell us how will this impact NBFCs, which anyways are grappling for liquidity injections to come in. They are sitting on cash, and now these new rules, which if it come into effect, will have an impact on NBFCs.
Yeah, good morning. These rules are welcome because, as you rightly said, that they will improve the health of the NBFC sector in the long run. But yes, in the short run, we have to see how NBFCs cope with it. My sense is that except for the very large NBFCs who have borrowed short term, for the most of the NBFCs and HFCs, it will not be difficult to maintain. But the problem will be the cost of compliance, because there are many principles which are difficult to follow. In the sense, it is on a dynamic basis, on daily basis. Then the investment had to be in government securities or cash. Even the FDs that we keep with the banks, that will be given a 20% haircut. So the compliance will be an issue. And I think unlike the banks who have a deposit base which moves on daily basis, for NBFCs we have a long-term funding from, it may not be matching the asset profile, but still it is a long term. So I think those changes are required. The cost of compliance will be high, But I think it is a good move.
Siddharth Purohit, you just heard Mr. Gupta as well speak about it. It's not, I mean, it's not extended to all NBFCs. It will be done at due course of time. But the current guidelines, if they come in the shape and form that the RBI has proposed as of now, what's your sense of the impact on NBFCs?
Yeah, hi, good morning. In fact, if the current guidelines are put into rules with immediate effect, I believe that the large NBFCs will have a better edge compared to the mid and smaller one. First of all, let me tell you that NBFCs had a clear advantage compared to banks because they were not they never had to maintain really regulatory liquidity like banks used to do. So now that the liquidity coverage has to be maintained and on a gradual basis till till 24 they have to maintain at par with banks. That means a certain portion of their liability or the resources has to be parked at a low yielding asset. So naturally the NBFCs will see some sort of profitability taking a hit because that money was getting lended to high yielding assets. So near term, certainly there will be a kind of margin hit if it is implemented to NBFCs. But one thing is certain that there had been a lot of issues with regards to NBFC because there were specific NBFCs which were borrowing short term and also lending in the long dated assets. So that was something not acceptable to the regulator because that was causing kind of ALM mismatch as well as liquidity concerns. So that will eventually go up. No, that's good for investor, but in the near term, I feel that market could react negatively to NBFC because of this outcome.
Yeah, actually, Mr. Gupta, that's the point, isn't it? Agreed, in the long term, it's a good move, but for the immediate term, at a point of time when NBFCs and the lower-rated NBFCs and the smaller NBFCs, which are anyways having a lot of issues of their own, if indeed the guidelines come into effect in the current shape and form, the near-term impact could be crucial, right? Impact on margins being one, because the margins will definitely take a hit. And all the NBFCs with an ALM gap or lower ratings stand to get hit. I mean, the non-housing finance companies, because I think housing finance companies are not included as yet in this.
Yeah, you are right to that extent. But I'll tell you, we did a back of the envelope calculation on the hit on the margins. For us, if we, like I mentioned to you last time in the program, the contextual liability and the behavioral liability. So if you look at contextual portion, for us it's about 250 crores per month is the gap on an average. Of course, it goes up and down, but the RBI gives the flexibility. Suppose it were to be implemented to us also, it will be only 250 crores. So we have to maintain 250 crores liquid asset at any time. Now, if you work out 250 crores, the gap will be about 4%. So 4% on 250 crores for the entire year is only about 10 crores. Now 10 crores. Our ROE, our net worth is about 1400 crores. So if we look at 10 crores and that too before tax, after tax will be only 7 crores. The impact on the ROE will be roughly 50 bps. It's not very huge hit. It is a hit, no doubt. 0.5% of 50 bps of the ROE reduction is a hit. But it also gives us the protection. So that is not the issue. The issue is about the calculations and the implementation of these things. I think NBFCs like us, mid-sized NBFCs or HFCs, are not equipped to handle that on daily basis to check, do active trading in treasury, have a treasury desk, full treasury desk. That will be, according to me, more of a challenge. ROE will be an issue, but it's not that much.
The cost of managing this compliance, Mr. Gupta, for small size and mid-sized NBFCs, do you think that will have a hit on the margins? You set up a desk, monitoring desk, active treasury management, all of that, does it take a bigger hit or no, not quite?
Yeah, it more than the margins, I think putting in place the system procedure will be an issue. Regulatory compliance might take a hit. I don't think, because if we hire some people and put in place systems, so
Got it. No, so I was wondering, since the Reserve Bank has said that this is a draft proposal and has invited feedback from participants, would you be one of those as well who would be giving their feedback to the Reserve Bank of India? How does this situation now work? Because I believe till June 14th is the time given for the feedback.
You are right, but that way to take a call because we are regulated by NHB. Whether we'll wait for NHB to come out with similar...
That's the belief, Mr. Gupta, that the NHB will follow suit.
Correct. So now here, there are few things which I just want to highlight through your program. Apart from, as I told you, there is no need to be daily dynamic thing, number one. Number two is that they should allow us to lesser haircut to keep FD with the bank. They should not insist on only cash or government securities. The third part is that for HFCs and NBFCs, the behavioral pattern is very important because our asset base has an average maturity of 14 years, but we find the prepayment rates are double the normal repayment. So that should be allowed to be taken into account based on, say, last 5 years, or the RBI should come out with some guidelines on that aspect. Those are the things we'll give. But as a proposal, we are for it. We believe we are anyway maintaining our own liquidity, of course, not by way of government securities, but by other tools. Similarly, we expect it will be good for the sector.
Okay.
Except for this integrity.
Okay, Mr. Gupta, we'll leave it at that. Thanks much for taking the time out and being with us. Siddharth, one final question to you. You mentioned that there could be a near-term hit that some of the smaller NBFCs, etc., could take. Could you give us a sense that whether these norms are very detrimental? I mean, there is a peer of yours who said that, as per their calculations, it's a 5% hit on profitability at worst for some of the NBFCs.
See, it is not very detrimental, and for investor, I would say it is rather positive because at least you get a clarity that which all NBFCs are really maintaining proper liquidity. Because even RBI is saying that you're have to give a disclosure of the sources. Now a lot of NBFCs, the well-rated NBFCs, are already giving a lot of disclosure. So now even the mid-sized one will have to give. So positive for investors because you get more knowledge about the sources of fund and the deployment of fund. So near term certainly, but another thing I would like to highlight is that most of this will not take a big impact on the well managed and well regulated top rated NBFCs. Those who have never really breached their ALM, they already had a kind of discipline. So it will not impact everyone in the same way. But the one who had been very aggressive towards lending without focusing on the proper sourcing will get impacted.
Okay.
So positives in the long run, as I said, but niche inflation would be there in the market.
Got it. Siddharth, quick 30-second answer. Based on these norms, any changes in recommendations on any of the NBFCs this morning to your clients?
See, NBFC, as of now, we as such have...
No, any specific names, I was wondering, Siddharth.
Yeah. No, as of now, for the last couple of months, we have been cautious on NBFC. And within the financials, our topics have been bank, not NBFC as of now. Because given the scenario, we have been positive on banks and not NBFC.
But you won't turn negative on any of the NBFCs after this?
No, certainly not. As I said rightly, the top ones will always be able to sail through, and this will differentiate the well-managed and top NBFCs versus the one which were not being managed properly. So the top one, I don't have a buy rating, but something like Bajaj Finance and Cholamandalam and all. So I'm not recommending all this, but these are well-managed NBFCs. Those will not get impacted too much, to my knowledge.
Okay. Siddharth, so good having you this morning. Thanks so much, as always, for taking the time out and speaking to us at Bloomberg Quint.
Thanks.
All right. Well, you got a lowdown of what these norms mean. So if you were confused at all, now at least you have an idea. Well, let's move on to the next piece on First Word. Subdued demand for automobiles is hurting the auto ancillary sector as well. Automakers are buying fewer parts as sales continue to drop. But some vendors have been hurt worse than others. Yatin Mota is standing by to tell us what and why. Now, Yatin, I remember we did a piece around auto ancillaries some time back.
Yeah.
What is it that we are trying to tell our viewers today?
So, Neeraj, the quarterly earnings for most of the auto ancillaries are out. And more importantly, if you look at the price performance of the auto ancillaries in the last, 4 months, versus key auto names, we have seen a significant amount of drop. Now, if you look at the screen, there was a 17% kind of a drop in Maruti's share price in the last 12 months. And look at PPAP Automotive and Lumax Auto. All of these stocks are underperforming Maruti Suzuki, with PPAP down, almost 47%. And that stock and that company, is a very large vendor to Maruti Suzuki. So, given the auto slowdown, we are trying to talk about how really are the auto ancillaries getting impacted. And if you look at Maruti as a company, a lot of companies have exposure to that. If you look at Lumax Auto, PPAP, probably company like JBM, Motherson Sumi, all of these companies have a significant portion of their revenues coming in from Maruti Suzuki. In fact, if you look at PPAP Automotive, nearly 50% of the revenue comes in from Maruti Suzuki alone. JBM, which is Jai Bharat Maruti, as the name suggests, they have nearly 80% of the business coming in from a company like Maruti Suzuki. So a lot of these auto ancillaries are directly correlated to the performance of what the auto companies really do in the marketplace. Now we spoke to a whole host of auto ancillaries from Bosch, Bharat Forge, PPAP Automotive itself, and most of the managements were of the view that yes, there is a slowdown in the auto ancillary business, spare part business. Replacement market is not that buoyant to compensate for the lack of growth in the OEM business. But Bharat Forge was quite optimistic moving forward. So if you look at PPAP Automotive, they say that of course there have been challenges in the industry, but moving forward, as the economic activity picks up, then and only then will the company's performance improve. If you look at Baba Kalyani, he was speaking to Bloomberg Quint. He was of the view that a lot of companies are looking at destocking, and because of the destocking, there are no new fresh orders in the marketplace. Of course, BS6 is one silver lining because of which the growth can happen in the second half. But first half, because of destocking and other economic uncertainty, most of the auto OEMs are looking at destocking. A lot of their clients are looking at destocking, because of which the growth is slightly lower. Now, let's focus also upon tire makers. Apart from auto spare parts and auto part companies, lighting companies, tire is one sector wherein we have seen significant amount of slowdown. If you look at the margin picture also for the last 5 quarters or so, excuse me, we have seen a significant amount of margin contraction. So if you look at the last 4 or 5 quarters for companies like JK Tyre, CEAT, all of them have seen a margin deterioration of nearly 200 basis points. Similar is the case with other auto ancillaries like Amara Raja, which is into batteries, Bharat Forge, Bosch has a significant amount of role to play in the emission norms, filters. There also we have seen margin contraction. So no auto ancillaries really spared as far as margin performance is concerned. Versus last year, clearly margins have come off for most of these auto companies. If you look at the sales growth trend also, we have seen a significant amount of deterioration as far as auto ancillaries are concerned. So let's hope monsoons are decent. Second half, because of BS6, we have a lot of pre-buying, which really helps auto companies and auto ancillaries get rid of their old stocks and now get into new product lines. But clearly, auto ancillaries again one space which is betting highly on the revival of the auto sector. Probably a GST cut or some kind of a scrappage policy is now required, which the government has been talking about for the past few years or so. So let's see how really do auto ancillaries benefit out of the revival of the auto sector moving forward.
Thanks, Yatin. Thanks for that. Well, from autos to aviation, it's been one of the most interesting times for Indian aviation. Jet Airways shutdown has opened up space for the other carriers, but there are still pockets of trouble in air. So how will all of this factor into Indigo and SpiceJet's numbers? Let's find out from Sumit.
So I'll start off with Indigo's first headline numbers. They're the 4 numbers. The revenues of the company are expected to be higher by nearly 36%. EBITDA is expected to be higher by nearly 76%, while margins are expected to expand to 25.1%. Now, this will be for the first time in the last 5 quarters where the company will see its EBITDA margins expand. Similarly, its net profit is expected to see a jump of over 3 times to close to 400 crore rupees. Now, for SpiceJet, revenues are expected to be higher by nearly 28%. EBITDA is expected to jump by nearly 52%. Margins, again, it will expand to 21.5% for the first time in the last 5 quarters, while the net profit is expected to be higher by nearly over 2 times to close to 115 crore rupees. So why the 4th quarter is expected to be a strong quarter? Mainly because of higher yields, lower oil prices, and a strong passenger growth that both Indigo and SpiceJet have seen in the 4th quarter of financial year 2019. Now, for the yields, if you see, Indigo's yields are expected to be higher by nearly 10% to close to 3.64 rupees per kilometer, while that of SpiceJet is expected to be higher by nearly 8% to close to 4 rupees per kilometer. However, some of these positives will be offset by a weaker rupee and a lower passenger load factor in the 4th quarter of financial year 2019. Now, oil prices, if you see, compared to last year, they were relatively lower by nearly 1%, while while rupee had depreciated to close to 70.5% compared to 70.5 rupees compared to 64.3 last year. Now, because of this, some of the dollar-denominated cost for the company is expected to be higher, but the company could still report a foreign exchange gain, because if you see compared to last quarter, rupee has appreciated, and that's the reason there could be some MTM gains that the aviation companies report. Now, for the passenger growth, if you see, Indigo's passenger grew nearly 20% compared to last year, which was the highest quarterly passenger growth reported by the company in the industry, if you see. Along with that, however, the passenger load factor, now that has come down to 86% from 89% last year. Now, for SpiceJet, if you see, the passenger growth was 13% compared to last year, and the passenger load factor have come down by nearly 300 basis points to close to 91% from 94% what it was last year. So this is what could impact the financials, but more or less the numbers are expected to be good because of higher yields, lower oil prices, and a strong passenger growth. Now, the reason why we are seeing a strong jump in the net profit is because the tax in this quarter would be nil, because if you see for the last 9 months of FY19, the companies have reported loss, so there could be some deferred tax asset that could be set off against the tax expense that they have in this quarter, and that's the reason the total tax expense would be nil. Now, the groundings that we have seen in the fourth quarter, how it will impact both the companies. Now, for Indigo, the cost could be higher because of these groundings, but for SpiceJet, they could receive some compensations from Boeing because of this grounding. So that will be one factor that one needs to watch out for when the SpiceJet earnings come out. That will be tomorrow. So that's an important thing that could actually result into higher profits for the company. Lastly, key things to watch out for both the companies' earnings would be the induction of new aircrafts done in their fleet by both the companies. Along with that, a management commentary on sustainability of the higher fares that we have been currently seeing in the industry. Along with that, the capacity guidance that the company gives for financial year 2020, and any commentary on the crude and ATF prices that we have seen and what they're expecting for FY20 will be important to watch out for from aviation earnings today and tomorrow.
Thanks a lot for that, Somit. That's all that we have on First Word today. Lots more lined up on Indian Open. We speak to Chirag Negandhi and S. Subramaniam of Axis Capital on the sidelines of their annual India conference. This is happening at 8:45 a.m. Discuss markets and macros under Modi government 2.0 with Bharat Iyer of JP Morgan and Sameer Arora of Helios Capital. But after this break, a full tilt towards the day's trade.